Good afternoon, ladies and gentlemen. Of course, I want to say good afternoon to those of you who are joining me here on the East Coast. We also, of course, want to say good morning to those of you who are joining us from the Central Time Zones, the Mountain Time Zone or Pacific Time Zones here in the U.S. And, of course, we want to say good evening to any of you who are joining us from across the pond in parts of UK or parts of Europe. Good early morning if you're joining us from parts of Asia or Australia. Well, welcome to today's presentation. Today we're going to discuss management techniques on your naked put position, selling a cash secured or a leveraged put option, which gives us, of course, a potential to generate weekly or monthly income to the upside on neutral to bullish stocks, may allow us to get into the stock at a discounted price, but as we see by the risk-reward profile here, we want to tend to avoid taking large losses. We need to avoid taking large losses in these positions, in these situations. But as we know, losses are going to occur. We can't control the market. Things don't always work out as we plan. So the purpose of today's presentation is to discuss some ideas of how you can help manage those positions that move against you. Now, before we begin, just briefly want to introduce Power Options. Power Options, of course, is a patented suite of search and analysis tools designed for self-directed options investors. Our tools will allow you to search across the universe of options in over 23 of the most commonly used option strategies to identify only those positions that match your risk-reward tolerance. Last week, Wednesday at 12 noon Eastern Time, we reviewed using the Power Options tools for identifying naked put positions. That presentation is available in the webinar archives. We'll show you where that is later on today in the presentation. This webinar, of course, is also being recorded, and we will post that in the webinars this afternoon as well, so you can access this at any time. Now, once you've identified the positions, you can quickly compare the risk versus reward using our tools, and then we do offer a powerful set of portfolio tools to help you paper trade, track, and manage your positions. We're going to be looking at those this afternoon as well. And for those of you that don't know me, my name is Mike Chupka. I'm the Director of Education here at Power Options. I've had the great pleasure of working with Ernie Zerenner, who created the Power Options tools 17 years ago. I've been working with him for the past about 12 years now. All of you that are on a trial or subscribers of Power Options, you know you can schedule a free coaching session at any time. I handle most of the coaching sessions, a lot of the education on Power Options, and obviously the webinars as well. Now today, of course, we're just going to be focusing on our thoughts on managing your naked put positions. Before we go any further, though, I want to remind everyone that when you first logged on to the webinar, of course, the GoToWebinar, GoToMeeting platform appeared on your screen. Inside that GoToWebinar platform is a question pod, and I want to encourage you that at any time during the presentation, if you have a question or a comment or a thought regarding what we're going over here with the management techniques and our ideas on managing the naked put position, please feel free to use that question pod to send me your comments, thoughts, or questions. I'll check that periodically throughout the presentation to make sure that your comments or your questions get handled as well. All right, so let's take the very basic view of the naked put strategy. Here we see our risk-reward profile of a naked put position. We're going to sell a put option on a stock that we're neutral to bullish on. We're typically going to be out of the money. Here we see the current stock price with the green line. I might enter a naked put here by selling a 53.5 strike with the stock around 58 or so. And we're going to generate a premium. As long as the stock stays above our put strike price, the put, of course, expires worthless. We keep the premium. But that's not always the outcome. We know there's three basic outcomes when we enter a naked put. Number one, the stock moves up, stays the same, or stays above our put strike price. Well, that's where we want to be, of course. Now, number two, the stock might drop slightly, or it might stagnate, and it might be in a range of, let's say, 1 or 0.5% or so of our put strike price, somewhere in this range. Now, that may require management. That may require no management, depending on your outlook and what kind of trader you are as far as being aggressive. And then, of course, the third one is what happens if the stock collapses from an unexpected event or moves below our break-even point or collapses unexpectedly. What are some of the things that we can do in that situation? We all know the three outcomes, but it's always good just to remind ourselves, I've entered this position, I expect X to occur, but Y, Z, or A, B, C could happen as well, so we want to make sure that we plan ahead and know what we want to do. Now let's talk about where we want to be. We sold a put option, we're getting close to expiration, the stock has moved up, maybe it's gapped up, or maybe it stayed just above our put strike price. Okay, well, management technique number one for this scenario is we can just let the put expire and then use our search tool to identify a new position for the next expiration cycle going forward. A management number two is we could let the put expire, and if we still have the same sentiment on the stock that we're in, we could simply write a new put for the next expiration at a higher strike price. We've taken most of our profit. We want to receive the full profit, of course. That's when we let it expire, rather than paying another commission to close the option or pay a little bit of 10 cents, 20 cents to buy the option back. If you're trading weekly options, it's usually best to let it expire because you were likely only collecting maybe 20 cents or 30 cents to begin with. You don't want to have to pay back that 3, 4, or 5 cents premium plus a commission, depending on how many contracts you have. But we could let expire and then just look for new positions that we're neutral to bullish on for the next cycle. We could let it expire and then following Monday just write a new put on the same security at a higher strike price or at the same strike price depending on our outcome. Now, management number three, of course, is if we're within 5 to 10 days to expiration and we've made 80% of our expected profit. So we originally sold the put maybe for $1 in premium. We're 5 or so days away from expiration. We can buy it back for 15 or 20 cents. Maybe a good time to consider closing that put, taking our profit off the table. If we have the same sentiment on the stock, we're still neutral bullish for the next 30 days or the next 7 days to 14 days if you're using weekly options, then we may just want to buy back that put and roll to the next strike price, roll to a higher strike price, get the premium and yield that we're looking for, and hope again that the stock stays above that put strike price going forward. So we may run an example of this later on, but this, of course, is where we want to be. This is what we expected to happen. It's always good just to review, hey, it was successful. What do we do going forward? Let it expire, look for a new position, stay in the same stock and write a higher strike, or close it early if you've reached 80% or so of your expected profit, and then roll up if you have the same sentiment on that security that you're trading. Our second scenario, we've entered the naked put trade, we sold our put, but now the stock pulls back in price, and as we get close to expiration, we're within plus or minus 1%. The stock's about maybe 0.5% or 1% above our put strike, or it's just below our put strike price. Well, again, what are our techniques? If it's just above, we could hold on and hope that it stays above to those last few hours of trading. I've done that before with some of my positions. We could let it expire. Usually that Thursday or Friday of expiration, if we're in this scenario, if we're around plus or minus 1%, we're probably going to buy to close that put and then roll out to another strike price. Maybe roll down in strike to get a higher probability. You know, I sold a 50 strike put, for example, that expires this week. The stock's now at about 49.10. Well, I may look to buy that put early before expiration, buy to close my put early, and then roll down to maybe the 48 or the 47.5 strike, going out another 14 or 20 days, but it has to match my profit. Of course, we could just close it. If our sentiment was the stock was going to stay neutral above 5 or 6% of our initial put strike price, but now it's within 1 or just a little bit below our put strike price, the stock hasn't matched our sentiment over the course of the time we were in the trade, we'll just buy to close the put perhaps for a small gain or loss, and then we'll look to identify new positions where we can make back some of that loss perhaps that we have a stronger sentiment on going forward. And of course, management number 3. We're just below the put strike price again. We sold a 50 put. We received maybe $1 in premium. The stock's at 49.50. Well, we could allow ourselves to take assignment. We were neutral to bullish on the stock to begin with. And from our previous conversation last Wednesday, part of our emphasis was on the fact we should never sell a put on a stock we wouldn't mind owning long term, because that is the true obligation of a naked put position. When I enter that contract, I do have an obligation to potentially have to buy shares of stock at that strike price if I don't manage it beforehand or if I get assigned early. So we should concentrate on only selling naked puts on stocks we wouldn't mind owning long term. But if we're just above, sorry about that. If we're just above break even, for example, or we still have a reasonable profit, we can convert it to a covered call or a collar. We'll take assignment and then make back the small loss we might have by converting to a covered call or collar position. All right, so these are some of the basic ideas. Yes, of course, and let's see here. Butch says, or you can buy that put back and sell the next lower strike. That's right. That's this option here. We talked about earlier we could let expire or roll early. That's what we were talking about. Management number 1. We could let expire or roll early if we're in that strike zone. We have to do that before expiration. If we've decided that we reach expiration, Butch, and we're just going to let it stay where it is, and we take assignment, well, the way to make back the profit, we're going to look to convert to a covered call or a collar position. All three are reasonable management techniques in this scenario, but it comes down to Martin. Is it Martin? I'm sorry. Hold on one second here. Got that question. Yes, Martin. Martin says explain a collar position. We're going to do that in just a moment. So, of course, that's just a basic view of some of the ideas. The stock's right around our put strike price. What are we going to do? Well, let's take a look at an actual example and actual numbers instead of just talking about it. Back on January 26, 2015, Southwest Airlines, LUV, was trading at $46.40 per share. At the time, we could have sold this Friday's expiration, weekly expiration, the 6th of February, 45 strike put for 55 cents. Now this would give us a 1.2% yield. The premium of 55 cents divided by our margin requirement, which would have been $44.45, our put strike price minus the premium, so we'd have a 1.2% yield for 11 days. Pretty good return. The theoretical probability that the stock would stay above our put strike price was around 71.6%. And of course, if we were doing a cash secured put, margin requirement would be $44.45, which is also our break even on this position at expiration. So for 100 shares, we'd have to put up $4,445 for the cash secured put, and we'd receive $55 against that in premium. Well, really $4,500 and then the $55 against. That puts us at our margin requirement. Here is our basic profit and loss chart for the LUV naked put position if entered on January 26th. Again, we take in $55. This is just for one contract. And that would be our 1.2% yield. And as long as the stock stayed above 45, remember it's at 46.40 for that 11-day period, the put would expire and we'd keep the premium. However, you notice here the stock currently is at 44.75. So it is just below our put strike price. We're in a position now where if we go through to the next 2 days, to Friday expiration on February 6th, we will be assigned on the put, forced to buy shares of stock at $45. And of course, we'd have still a small gain on the position because remember our break even was $44.45. Of course, the stock could continue to decline slightly over the next few days. Well, let's talk about our current position. Love's currently at $44.75. It's about $11.20 this morning. It's just above our break even. However, yesterday it had dipped further below that. It was at $43.25. So that means we were down. Essentially, if we took assignment at 45, we'd have a loss of $1.75. So we put the stock, sorry about that, folks, we put the stock at $43.25 at 45, but we keep the 55 cents, so we'd be looking at a loss of about $1.25 on the position, or $1.20 on the position from our original cost basis. But today it's looking a little bit better. There's a pop-up in price today, so we're looking pretty good there. All right, so the current bid-ask of our 45 strike put for Friday's expiration is 70 cents to 155, which puts us at a midpoint of $1.15. And in last Wednesday's presentation, we talked about always looking to use the midpoint when you enter a naked put trade, or of course when you're looking to manage the position. So using the midpoint, our liquidation loss right now would be 60 cents. Remember, we took in the 55 initially. If we got closed at the midpoint, if we were able to get that for the closing price, we'd have a loss of 60 cents. We paid $1.15, so our total loss would be 60 cents on the position. Now, what are our opportunities here? Management number one, we could close the put and just take the loss, and then try to make it up later by looking at a new put that's maybe 14 days out in time on a stock we have a stronger sentiment on now that LUV has gone against us slightly over the past 11 days. No one wants to take a loss, but remember, in order to just simply decide, as we mentioned, Butch, to just roll down the put option, it has to match my sentiment. And something we're going to talk about later is I don't want to see investors rolling for the sake of rolling. In other words, you might have been taught, hey, your put goes against you, just buy it back, roll down the lower strike price. Credit spread, your bull put credit spread has gone against you, roll down the put spread to two lower strike prices and just stay further out of the money. Well, if your sentiment has changed on the stock, you're no longer bullish on the position, don't roll just for the sake of rolling. Make sure that you still have a neutral to bullish sentiment on this position going forward from where you are now. Management number two, as we just discussed, close the put and roll to a lower strike. Now again, that still has to match the sentiment, and we want to make sure we're recovering that 60-cent loss. If I liquidate the position right now, I get filled at that 115 midpoint. We've got a loss of 55 cents or so. Or sorry, the loss of 60 cents, my apologies. If I just roll down to, let's say, the 43 put on LUV for 1 week out or 2 weeks out, and I only get 30 cents, that has a maximum gain now of a 30-cent loss. It's not recovering my position. I may have to go further out in time to recover the 60-cent loss I'm taking on the current position, or be more aggressive and take a higher strike price that's closer to the current stock price. So it has to match your sentiment, your comfort level, and you need to recover the loss you're taking on the current position. And of course, management number 3 is do nothing right now. Well, being Wednesday, do nothing right now, but let's say it was, let's assume it was Friday expiration. Well, we could do nothing as far as management. We could let this put stay in the money through the close at 4 p.m. on Friday. We'll take assignment, and then on Monday we'll look to convert this to a covered call. Okay, so we know our cost basis would have been $44.45 if we're put the stock at 45, and the stock's currently trading around that price, around $44.70 or so. So we could maybe sell the 1 week out or 2 week out or standard expiration 45 call, or if there's single strikes available, maybe the 44 call if it gets us back to a new gain. Okay, so that's the ideas and the concepts. Now let's take a look at some numbers. We're going to navigate over to our Power Options suite of tools here, and we're going to take a look at that LUV position, and this is where we're also going to describe the collar position visually a little bit better for Martin as well. Okay, so let me change my screen, folks. And what we're looking at here is the basic setup of a trial account, I should say, on Power Options. And when I have various positions, whether they're spreads, naked puts, or so forth, I'm going to track the positions in the portfolio tools. All right, so let's go ahead now and go to My Portfolio. And in the portfolio tools, we're going to navigate right over to the main portfolios view. This is where I track my open positions. Here we have 2 naked put positions that we've entered here. We're going to go back to the second position later on when we talk about DECK. But right now we're going to take a look at the February 45 put on LUV. Now it's up a little bit more. Okay, it's currently at 44.81. Remember, we sold the put for 55 cents, but the current ask price is at $1. So we're still looking about a 55-cent loss on the natural ask price. We'd probably do a little bit better with the midpoint. And as we scroll over here, we see our original expected return was 1.2%. Right now we have a loss of $45. We've almost negated that initial $55. And if the stock stays at the same price it is now to expiration, our expiration gain or loss would be about $36 because we're just a little bit below the put strike price. We still have a $36 profit, which is close to that 1.1 or 1.2%. But we're in this range now where the stock is below our put strike price. Want to evaluate some management techniques. Now, in the invitation I sent you today, I mentioned that we try to do some of the heavy lifting for you. As I'm evaluating or tracking any position in the portfolio tool at Power Options, I'm going to use the More Information button here to the left-hand side. We're going to go to Position Actions and then Position Analysis. So as you enter your position in the portfolio, you can link to the Position Analysis screen, and this will give you a breakdown of your current position. So here's our basic profit and loss for the LUV position, similar to what we saw on the slide a few moments ago. Still have about 1% of time value left in price for 2 days remaining to expiration because our put is now at the money. We opened it, it was slightly out of the money with a 72% probability of expiring worthless. The stock has fallen in price, trading right at just below our put strike price. As we saw before, the current liquidation value, we have a loss of $45, or loss about 1%. That's based on the margin requirement we had for the original position. And if we held it to expiration and the stock stayed at 44.81, well, if we bought it back, it would cost us $19, assuming just intrinsic value, and that would be a return of about 0.8%. However, we're not sure what's going to happen over the next 2 days. We're concerned the stock may continue to drop, so we want to evaluate some of these positions. And we see here we have a variety of different rollout opportunities for the next week's cycle. So going out to February 13th, 9 days out in time, or going further out to February 20th, the standard expiration for February, which is 16 days out in time. So we're showing that, okay, we could buy our put back for $1, the natural ask price, and then we could look to sell some of these new put options. With the stock trading where it is, of course, roughly at about 44.81, remember, well, we could look at the at-the-money 44.50 put. This would give us 95-cent net credit or premium for selling that new put option. And our adjusted net credit would be 50 cents. Okay, so that's taking into account our original 55-cent premium, okay, minus the dollar we'd have to pay to buy it back, so it would be a loss of 45, and then we're taking in a new premium of 95 cents. And this would give us for next week a 1.1% yield. Now remember, we're at about a 0.8% yield if the stock stays at the same price between now and expiration. We are at a 1% liquidation loss, so this is taking a current liquidation loss into a potential gain. However, depending on your outlook of the strategy and your trading plan, rolling for the sake of rolling, the stock has fallen to 44.81. This 44.50 put for the next weekly cycle, 9 days out in time, is only slightly out of the money and only has a 54% chance now of expiring worthless. Does that match your expectations and what you'd originally looked for on the position? Well, probably not. And we're probably looking for a higher probability. But remember, if we roll to the higher probability, let's go to the 68%, close to 70% for the February 43.5 put for the February 13th cycle. We'd get a new 60-cent premium, but this is only 15 cents positive net credit. So we're changing our yield from a loss of 1% to 0.3%. Again, does this match your trading plan? Okay, Butch brings up a good point, and we're going to talk about that in a little bit, but I'll bring it up now. Butch says, before I sell a position farther out, I will check to see if the stock has earnings. I won't set up a trade if it runs into earnings. Exactly, Butch. We covered that last week in the original position. I'm going to cover that later on in the presentation as well when we talk about the rolling and adjusting. For right now, we're just looking at the basic examples of the rollout opportunities. So this is doing the calculations for you, but you still have to decide what works best for you. We know we're at a current loss of 1%. So what is the probability we want to see for the next roll? And if I want to make sure I'm getting a higher positive adjusted net credit while still keeping a good yield, I may have to go 23 days out in time or further out in time to keep the probability I want and to turn my loss into a winner that I want as well. Now, before we go any further, let's just take a look at one of the 16-day out trades. This one here, with the standard 1% yield. We know we have a 1% loss now with 1% yield, only about a 64% probability. That's that further out February 43.5 put. So we can go down further out of the money and get about the same 90 to 95 cents that we saw with the at the money that's just 1 week out in time. Now, not all securities, of course, offer weekly options. It's 4,400 positions that offer optionable stocks, indexes, and ETFs. Only about 400, 1/10, offer weekly options. But we want to compare here what is the premium we want to receive for the new adjusted net credit versus our yield, and what probability do we want. Now, it's great to see things numerically, but as you're looking at the position here in the rollout opportunities, I can go to Simulate Trade, and this will give us a side-by-side comparison. On my left, in red, is my current naked put position. The February 45 put expiring Friday. We have a current loss of 1%. We may still make the 1.2%. The stock recovers above $45 in the next 2 days. But if we buy to close our current put for $1 and sell to open the new put, we'll still keep a positive premium of 45 cents. This only puts us at a new yield of 1%. But now if the stock stays above 43.50, so we've given ourselves another $1.30 of loss potential for the next maybe, sorry, this was a 16-day trade to February 20th. So for 16 days, we've given ourselves another little cushion here. We've got about a 64% probability. But again, I would only do this if LUV still matched my neutral to bullish sentiment. If I still thought, even though I was wrong in the first cycle, if I still thought the stock was strong, as Butch mentioned, there was nothing that would cause me hesitation for rolling into the position. Anytime I do an adjustment or I evaluate an adjustment on a position that I have a current loss on or looking to follow my rules for adjusting in any strategy, I reevaluate the stock position the same way I did when I opened the new position. I look at the chart and I make sure that it's, even though it's pulled back, is it still what I feel a strong pattern for the sentiment I'm in this case a neutral to bullish position. I want to make sure, just as Butch mentioned, that there's nothing going forward that would cause me hesitation for entering the position. If I have earnings coming up between now and February 20th, let's say we'd originally opened the 6th of February put because the earnings were coming out on February 10th, but now rolling to this type of position, going out to February 20th, I'm going to cross the earnings event, and this might not be a risk profile I want to see being exposed before the earnings event as well. Or if there's anything else in the headlines that would cause me hesitation, anything such as a rumor of a boardroom change or a boardroom scandal, a pending patent lawsuit, judgment on a lawsuit coming out for the company, anything of that nature that's supposed to be coming out before the next expiration, if I'm not comfortable with it, then we'll go back to management number 1. I'd likely just close the put at this time, take that 1% loss, and then look for new positions using the search tool that match my criteria going forward and will help me make up the loss on this particular position rather than stay in the same one. Okay? So those are some of the ideas that you'd look for when rolling the position. First, with just the put, you just want to make sure that it matches what probability you'd still want, the potential gain you'd want for your time frame as well. And of course, we are looking to turn a loser to a winner, but it has to match our sentiment. Now, we'd also mentioned another opportunity is to simply take assignment. So let's say we were at Friday expiration. We haven't closed the position, so I could just allow the put to be assigned to me. We know that we're still slightly above break even in this situation. The stock's at 44.81. If we took assignment at 45, we keep our 55-cent net premium, so we have a cost basis of 44.45, and the stock's at 44.81. But what we could do now is look to convert our position to a covered call. So here we see some of the out-of-the-money and in-the-money opportunities for the 16-day out cycle. Those that are shaded in gray here are the in-the-money, of course. If we were put the stock, we could sell the at-the-money February 20th 44.5 call for $1.55. Slightly more premium. Remember the 43.50 call we looked at only had a bid of 90 cents. This is 205, but remember, that's $1.30 in the money. So this is really only 70 cents of time value. The naked put actually has a higher time value. Why do I bring that up? Well, if your goal is to maximize time premium, that's something you'd have to look at. I want to go over this again. The February 43.5 call, if we took assignment, and right now we sold the February 43.5 call for 205, remember the stock is currently trading at 44.80. So we're roughly, let's just call it 44.80. Let's call it $1.30 in the money, right? This is a call now, so it's in the money. We're $1.30 in the money. So the time value for this option, our short call, is about 75 cents. Okay, that's the time value we're receiving. We are taking in the intrinsic value, don't get me wrong, but at this case, we're looking at 75-cent time premium. The time value here for the same expiration, 16 days out, for the 43.50 put is 90 cents, so it's 15 cents more. So in this case, to maximize time value, it might be better off buying to close the put and rolling down to the February 43.5 put as opposed to taking assignment and turning it into a covered call by selling the February 43.5 call. Remember, the game is to maximize the time value premium as an option seller, so you'd want to compare those two to see which one gives you the best time value in these rollout situations because they're very close. All right, so now we see this position, and again, we have the same probability, of course, 63.7%. We want to evaluate the trade side by side. And of course, here we see the view that we're looking at. Number one, the current return we know, our current position, we have a loss of 1%. It still might be 1.2% if the stock goes above 45. But if we take assignment, we'd have 100 shares of LUV with a cost basis of 45.26. And where is that coming from? Well, it's allowing the stock to be put onto our position. We buy to close the position for $1. Okay, so that's the difference. We did have a cost basis of 44.45, but adding back in that 45 or 50 cent loss, that puts us back to 45.26. But in the 43.5, call it 205. So now if we get assigned, we'd have a max profit of $29 or 0.7%. So again, we're turning a loser into a winner. That's good. Right now we have a loss of 1%. We're getting that 1% back plus an additional 0.7% gain going forward. However, we saw that the naked put, by simply buying to close our 45 put for the $1 roughly, and then selling to open the February, same expiration, 20th of February, 43.5 put, would take in 90 cents instead of 70 cents time value, so it would give us a 1% yield rather than the 0.7% yield. Now, why would I do this in the situation that we see right now? If the covered call is offering a lower time premium, about 15 to 20 cents, and I could roll to the naked put and get a higher time premium, why would I still allow myself to take assignment and sell the call? Well, one thing to consider is if the stock pays a dividend. Okay, now, again, we talked on Wednesday that if the stock's a dividend-paying stock, you're likely better off just going into the covered call as it is if you're comfortable with this risk-reward profile. Because with the naked put, if you're crossing the ex-dividend date, one of the other things you want to consider is you're not going to take advantage of that dividend. So you may just want to be in a covered call position at that time. But if the stock has an ex-dividend date coming up between now and February 20th, I may be inclined to take assignment on the stock, convert it to a covered call, so I'd also collect the dividend, which would enhance this percent return potentially above just rolling the naked put itself to the February 20th 43.5 strike price. Okay, now let's go back to square one. We're going to do something a little bit different here. Here's our rollout opportunities, and again, you see all your probabilities. We're doing all the math for you for the rollouts as well, so that's sort of the advantage of the tools, but we just wanted to illustrate it mathematically what we're looking at. Now, the other management technique we talked about in this situation is converting it to a collar. And Martin, of course, asked, what is the collar position? But when we refer to collar, we typically refer to a standard collar, which instead of going into a covered call position or a naked put, what I might have done is bought shares of LUV originally at this price of $46.40, and we may have sold the $46.50 or the 47 call for this Friday's expiration, but at the same time bought a 44 put. Okay, so it gives us a risk-reward profile, Martin, that's similar to a bull put credit spread or a bull call debit spread, but we're not using margin to enter the position. Well, now that I may get put the stock, it doesn't show a collar opportunity here, but if I'm concerned about further downside on this position, I might be able to convert it to a collar rather than a covered call, but I don't think we're going to see a profit, but let's take a look. Since I didn't see the collar opportunity here in my rollout positions, I'm going to go to the what-if calculations, and we're going to simulate this manually. Here's our naked put again. We've got our 6th of February 45 put for 55 cents. We're going to assume, let's take assignment on this stock so we know that we're going to have 100 shares of stock at a cost basis of $44.45. Well, we put stock at 45. We keep our 55-cent premium, so we now own 100 shares of stock at our break-even price of $44.45. So let's add that in for LUV. We'll put in 100 shares at $44.45. Now, as we saw before, now that we're put the stock, we could consider maybe going out 9 days to the weekly option on February 13th, happy Friday the 13th, or to the standard expiration of February 20th, which is 16 days out in time. Let's analyze the February 20th and build things on the fly. Then let's say that after we got put the stock, we're still relatively neutral to bullish on the LUV position. We think it may stay above 45. We could repair by selling the 44.50 call, the 44 call, or the 43.50 call. We saw that in the rollout opportunities. But let's say I'm going to sell the at-the-money 45 call right now. The stock has moved up since we've been discussing this. That's why it's looking in the money right now. As it turns out, I believe this. Well, I'm sorry, the stock's at 45.05, so it's right at our put strike price. But I'm going to try to manage this by selling the 45 call. We've got a bid of 145 and an ask of 160. Midpoint, let's just call it 150 and be nice to ourselves. So I'm going to add that in. Let's sell the call at 150. Okay, so we had a put position. We were neutral to bullish. Sort of went against us. Stock's fallen in price. The at-the-money call helps us convert to a max profit now based on our cost basis. We'd lower the cost basis down to $42.95. If we got assigned at 45, we'd have a profit of $205 or 4.8%. Again, as Butch mentioned, before I did this, I'd have to see if the stock has earnings coming up. Let's take a look here. Real quick, I'm just going to go to the stock research tool. Earnings already passed. We had those a couple days ago, so the next earnings is at 4/23. Okay, so we've passed earnings already. That's good. We're not concerned about that, but we want to verify it before moving forward. Now, this solves the problem of turning a loser into a winner. Currently at a liquidation loss of 1% on a naked put, we took assignment, converted to the at-the-money covered call, which is a lower probability, but we now have a 4.8 potential % return if assigned. but we haven't addressed the downside. If we're hesitant on LUV, even though we did this adjustment to try to minimize the loss or turn the loser into a winner, but we're concerned about the airline industry that maybe it's run its course and it's going to start pulling back, we want to repair this position, but we're worried about the downside. We know that a stop order can help in normal market conditions, but in the case of a gap or large decline, we may get stopped out early for a loss on the position. Stop order doesn't protect you against any type of overnight gap, weekend gap, or pre-market gap as well. So to lock in some of that risk, to protect against this large exposure we have, which we always have with a naked put position or a covered call, I may convert it to the collar. So we've got our covered call set up now that we took assignment, but I'm going to look forward to February 20th. I'm going to keep the same expiration date as the call that we sold. I know I'm collecting about $1.55, so I'm going to look for something that's about half of that, maybe 70 to 75 cents. We see the 43 put and the 42.5 put, 60 to 80. I think I like that best because it's a 2.5 point strike difference here. We're going to put in a midpoint of 70, so we're going to buy the 42.5 put at 70 cents. Take away about half of our return, but this is now taking that conversion to a covered call one extra step. We're converting it to a collar, and we still have a max return of 3.1%. And we've mitigated the downside to only 2.6%. So if the stock continues to fall, if it drops down below 42.5, we could only lose 2.6% in the worst case scenario. Okay? And if you were more aggressive, you could use a lower strike put. You could use the 40 strike put, which would cost you less and it would increase your risk, but at the same time the lower cost would still keep a lot of that premium. So with the at-the-money strike, if we think love would recover, and the next 16 days we didn't see anything in our research and analysis that would cause us hesitation again, the stock has moved against us, it didn't perform as we wanted to, take assignment on the put, and convert it to a covered call. We saw about a 5% yield almost in this scenario for the at-the-money strike. A little bit risky, remember, it doesn't have that high probability of getting assigned and making sure we're going to get this. Just the covered call left us with a large exposure. Converting to a collar now, paying out some premium to protect the downside. We have a nice collar position for the next 16 days where we have a max return of 3.1% and a max loss of 2.6%. Now, the concern here, of course, is if I'm this hesitant on the position and I'm concerned about it falling, maybe I should just take that 1% loss I have now instead of potentially doubling it or more than doubling it to 2.6% if the stock does fall below 42.5 in the next 20 days. Okay, that's going to come down to the research and analysis on the stock, and your sentiment, and just from one trader to another. If you have that feeling in the back of your mind that, well, I'm concerned about the risk, maybe I should convert it to a collar because I'm afraid it could still drop down to $41 or $42.5 per share, well, this is a good way to protect it. But if you do have that thought in your mind, maybe it's better to close now for the 1% loss and try to make it back with other positions that you're more comfortable with instead of worrying about this one as you convert to a covered call or just roll to the lower strike naked put. Sentiment is truly important as well. Okay, so let's navigate back over now to our slide presentation. Anyone has any question about that concept, that scenario where the stock's just within 1 or 1.5% or so, or a little bit above, a little bit below our put strike price, and we talked again about those three scenarios. Let's move back forward. The three scenarios, the stock's right around our put strike price. Close the put and take the loss if your sentiment has changed. Management number 2, we showed lowering to a lower strike price. Make back the loss that you've took and still look at a positive upside, but it has to match your sentiment for the stock and the probability that you want. And management number 3, we could take assignment, and then we can convert it to a covered call or potentially a collar if we make up the gain that we want. And again, we still have that good probability that we'd get assigned and earn the return. All right, now let's talk about the main one that I get the most phone calls about for covered call positions, naked put positions, the thing that everyone wants to avoid but always happens once in a while anytime you're trading for any extended period of time. Outcome number 3, the unwanted gap down in price. These situations do happen and they can't be avoided. Whether you're using a stop loss or other management techniques, contingent orders, if the stock gaps down 20% and you had a stop order, you get filled at the worst possible price. You now have an unrealized loss of, let's say, 15 to 20% on this particular position, but your other 5 or 6 naked puts you opened only made 1%, so you've probably wiped out 10 to 15 previous positive premiums And it may take you, figuring if you just make 1 or 2% on a covered call premium to roll, now that this position has had this decline, it may take you up to 7 to 12 months of management to get back to break even if the stock now stagnates after that large decline in price. All right, but what can we do about it? Let's try to look at some evaluations here. Here's a new trade. And this goes against Butch's rules, but I'm cherry picking and I'm using this as an example of the worst case scenario. January 16, 2015, Deckers Outdoors is trading at $86.46. It's had a good run over the past 5 or 6 months from about $68 per share up to about $86 per share. It's been higher than that and then pulled back slightly. But following our basic criteria, we want to look for a position that's offering at least a 1.5% yield for maybe a 15 to 30-day out trade. We want a good probability, maybe above 75%. So on January 16th, we could have sold to open the 6th of February expiration this Friday, 79 strike put at $1.65. It's a pretty good premium. This gives us a 2.1% naked yield on our investment for 21 days. And of course, at that time, we had a probability that the stock would stay above our put strike price of 77.5%. Of course, today, the current position, Deckers Outdoors, is around $71.32. We're roughly $7.70 in the money on our 79 strike put that we sold. This was a gap down due to earnings. I put the asterisk there because, as Butch mentioned, and as we mentioned last Wednesday, when we run our search in power options, we always select to avoid stocks that have that earnings date between now and expiration. We wanted to see if there's any potential here for management in these scenarios, which do happen. So the current bid-ask for the 79 strike put that expires on Friday is $7.40 to $8.50. So the midpoint would be $7.95. Where we collected $1.65 originally, we keep that. But buying the close it now would be a cost of $7.95. So our loss for one contract would be $630 or $6.30 per contract. All right, so it's about 4 or 5 times the original premium we expected to take, meaning we've likely wiped out 4 or 5 previous profitable trades with this one unrealized loss. All right, so the major gap down occurs. What are our management techniques? Well, they're somewhat similar with a little bit difference to what we saw before. Number one, we can pay the premium of $7.95 at midpoint, take the $6.30 loss, and hope we can make that out over time. Well, no one really wants to take that loss, let's be honest. We're going to try to find a way to manage this if possible. If we do decide to just buy to close it and take the loss, we've now got a loss of $6.30. Assuming we're making 1% or so on our naked put premiums and we're getting close to $1 for the puts that we're selling, or maybe 50 cents, you are looking at maybe 5 to 6 to 10 positions just to get back to break even from this one unrealized loss or realized loss in your portfolio. And as Butch mentions, the only reason I know about earnings is it was a very expensive lesson. Yes, and this would have been too with Deckers Outdoors, absolutely. All right, so management number 2, what we saw before. We could buy to close our put for the $6.30 loss. Remember, paying $7.95, take the $6.30 loss on the position, and then roll to a lower strike. Now that Decker's down at 71, could we sell a 68 put or a 65 put or maybe even a 70 strike put out in time to make back that $6.30? Well, let's be honest. First, there's a spelling error. I apologize for that. That should be an I. If you've got a loss that's 5 times what you originally expected, or you've got this monetary loss of $6.30, rolling just down in strike, you're going to have to go maybe 10 or more months out in time to even come close to this premium. And now if I roll this put out 10 months, I roll down the 70 put, let's say, 10 months out in time, 12 months out in time, and maybe get $5 or so to help hedge the $6.30 loss. Number one, I've got my capital tied up in this position for the cash secured put for several months before I see any relative time decay. No one can estimate or plan what's going to happen in the next 12 months, and you're also going to cross another 2 or 3 earnings cycles for that 10 or 12 months you have to roll out in time to try to roll for a credit. So this is not a likely management. I bring it up because it's a common thought, and I see gurus that charge $1,500 or $1,000 for a weekend seminar and covered calls and naked puts say, oh, well, the stock's gapped down significantly against you. It's perfectly fine. Roll down your covered call 12 months out in time to lower strike price, or roll your put out 12 months out in time to a lower strike. You'll get most of that credit back and it's fine. Well, not really. I'm not saying that there's obviously a better solution. There may be, and we're going to look at one in a minute, but this is very difficult to swallow because you're sitting on the position for 10 to 12 months just hoping to get back to break even, there's no way we can speculate what's going to happen in the next 10 or 12 months. That could work out for you. That's true. You could convert a loser to a winner by leaving that capital tied up for the next 12 months or so if you get the good enough premium. But it's not always the best answer. Management number 3, take assignment and convert to a covered call that we saw before, same issue. You know, if I'm trying to roll for a credit or I'm converting to a credit, I want to make back this 630 immediately, rolling to the covered call, I'm either selling a call that's well below my cost basis for the stock, so I could get assigned early for a loss, or I'm going to be sitting in this position for 10 to 12 months trying to make back that 630. This type of loss, these other management techniques we already discussed for if the stock's just below 1% or so of your put strike price, aren't going to repair it right away. You're either going to be in the position for an extended period of time, or you're just going to be sitting there managing month by month to just kind of hedge that loss down. Another thing that's available in these situations, we looked at this on Friday during our open discussion presentation, is something called the stock repair. In this situation, if the stock has dropped significantly, and I feel it's an overreaction due to the earnings, and there's some potential the stock's going to come back up in price, instead of taking the loss or trying to manage it for 12 months, we may be able to average down and evaluate what's called the stock repair. And let's take a look at that as another potential adjustment on the position. Okay, let me go forward here. All right, so we're going to evaluate the repair on the Decker's position. We're going to look at what would happen if we took assignment. How far out would we have to go to try to manage the position with a covered call? Or rolling down the put, for example. And then we're going to look at the averaging down and evaluate a repair as well. So let's go back to Power Options. And we're going to go over to our portfolio screen again. We already saw the position on LUV. Now let's take a look at DECK. All right, so the stock is currently trading at 71.54. We've sold the 79 put that expires this Friday. We did take in $1.65. The natural ask right now is $8.50. That's the worst case scenario. So on the natural ask alone, we're looking at a loss of $685. It's only 8.7% of our margin requirement for the 79 strike put, but this is not where we want to be, and I don't want to take that $685 loss, which is about 4 times the premium we originally received as well. No, about 3.5 to 4 times. All right, so step 1, as we did before, tracking my position in the portfolio. Stock has moved against me, as we did with LUV. I'm going to evaluate now potential rollout opportunities where the system's going to do the math for me. So we're going to go to Position Actions and then Position Analysis. We know the current situation. There's our short put at 79. Our break even was roughly 77.35. The stock is trading at 71.54. We've got that loss of 685 or 8.7%. That's based on buying back the natural ask price. We hold it to expiration, of course, and allow the stock to be put to us at 79. If the stock's still trading at 71.54, this would be a loss of 7.4%. Where's that 1.3% difference coming from? Well, it's because of the volatility on this particular option. Even with 2 days left to expiration, the current option has a 1.3% time value. So it's showing us if it's held to expiration, the stock was roughly around the same price, we'd get that extra 1.3% and only now have a loss of 7.4% as opposed to 8.7%. So as we scroll down and look at some rollout opportunities, we see now that we could roll down from our 79 to our 78.50 put and collect 720. But this doesn't solve the problem. This is a rollout that's adjusting it to a positive yield, but look at where it is. It's the March 78.50 put, 37 days out. Here's an April 77.5 put at 7.50, which would put us into a positive gain. So instead of taking the 8.4% loss, 72 days from now, we might have a gain of 0.8% by rolling down this put. The problem here is that, again, 77 days out, what did we already see for April? We know likely the next earnings cycle is going to be coming out around this time, so we have to be very careful about that. But number 2, the stock's at 71.54. This put is still deep in the money. We're showing it to you as a potential adjustment, but I'd only do this if I have some glimmer of expectation that Deckers would come back above 78.50 at March expiration or above 77.5. Look at the probabilities, 20% potential, 29% potential. That doesn't cut it. That's probably not going to be a profitable position to roll to. Even though we're showing it to you as a potential where it could result in return, staying in the money this deep You're hedging that loss a little bit, but now you've only got a 20.7% chance that this would stay above that and you'd convert this loser to a winner. Okay, and of course the other concept is you may get assigned early, be forced to buy the stock at 78.50. You do hedge it a little bit, but this is not, we're showing it to you, but this is not something I would likely consider because it's still now so deep in the money, and I probably don't have the expectation that in 37 days from now or 72 days from now, crossing another earnings, that this stock's going to be above these two strike prices. And notice the idea of converting to a covered call, we don't see any opportunities because the loss is too big. All right, so what are some of the other things that we can do? Well, we could evaluate on the fly those covered call positions, just see why they didn't show up, how far out would we have to go. Let's go ahead and do that. Now remember, our stock, we sold the put at 79 strike. We're taking $1.65, so our break even is 77.35. If we take assignment, these 100 shares, our cost basis would be 77.35. How could we get back to break even now with a stock at 71.54? Let's take a look. I'm going to go to that what if calculations again. Becky asked a question, if you average down, aren't you going over the ideal trade side based on your portfolio? Absolutely, but do you want to take the 8? This is some things, this is the give and take, Becky, that we have to face sometimes, and I agree with you 100%. I had originally opened this position, of course, with the concept that I only put in a certain amount of money and took on a certain amount of margin requirement that matched my goals. Averaging down now has two cons to it, and we're going to discuss those in a minute. The obvious one is now I'm exceeding my position size for what I'd want to be in the position. I'm throwing good money after bad. That's another position. But is it better than taking an 8 or 7% loss? And if we think about it, even with this gap down of about 15 points from the stock was at 86 down to 71, a loss of only 8 or 7% is not that bad. I mean, I have customers that call up that have 33% losses if they get assigned the stock. And that's harder to do, but it's something you have to consider that at this point, how long would it take you to make back that loss? If you're averaging 1% yield on your other naked put positions every 20 to 30 days, and you take that realized 33% loss on that one position, how long is that going to take you to get back to break even just rolling different positions? Well, you're talking about 33 trades. And if you're only doing 6 to 7 trades per month, well, that puts you at 6 or 7 months to get back to break even, assuming all of those trades in the 6 or 7 months work out to the max profit, which is, we know is not going to be the case. Okay, so let's take assignment. Our cost basis would have been 77.35. So let's add our stock in, 100 shares of DECK at 77.35. We have a loss now roughly, sorry, too much entry. We have a loss now of about $6, just around $6. Okay, so let's take a look at our call options. We're taking assignment on the stock. We got to go out in time. Let's go to March. 70 strikes at 390. Well, that's well below our cost basis, and we're only getting 390. That's not going to solve the problem. The out-of-the-money options aren't giving us any real premium. The 77.5, which is near our strike price for March, that's only $1.05. So if we wanted to try to get back the $6 immediately, what are some of the things that we could do? Well, let's go out to January, 345 days out in time. All right, here we go. 1050 for the 70. Does that put us back to break even? Well, I don't think so. Let's try it. Let's put in a cost of $11, 1050 to 1210. Let's put in a midpoint of $11 for this deep out in time January 2016 call at the 70 strike. Would this get us back to break even? Cost base now is 77.35 on the position. Should get us back to break even easily. All right, so here we have a potential profit with the at the money call, slightly in the money call, the 70 strike. It's all the way out to January. We could convert this to a gain of 5.5%. That does fix this issue. But now we're in the position for 12 months. We're sitting on this for 12 months. We're not going to see the time decay on this option until really we get the last 60 to 90 days. So assume it's still 9 months sitting on the position before we start seeing the rapid time decay where it would make sense to buy to close this or maybe get back out at a profit. Could we be signed early? Potentially, but I wouldn't count on it. Okay? We don't solve the downside here. We do convert a loser to a winner. But now our capital is tied up for about this 10 to 12 month period on the position. We did get back to break even. We converted the 8% loss we'd have now into a potential 5.5% gain 12 months out. And again, what we have to consider in this scenario is with a 12-month out, 5.5% yield for 12 months out in time, you're definitely receiving less than 0.5%, repairing less than 0.5% per month. This is another thing that you have to consider if this is part of your adjustment techniques. It's not something I approve of doing. Okay, we're taking assignment. We have a $6 loss. I'm going to repair it by selling farther out in time. We've got a cost base of $77.35, a max profit of $365. What is that taking into account? Well, we're selling a call that's $7 below our cost basis. We're taking in $11, so we're recovering that and then repairing it for a profit of $365 over a 12-month period. Now, the reason I don't like doing this is as options investors, we covered this last week, but as options investors we know one thing. If you sell month by month by month or week by week by week, you're going to get a better annualized return. It's also easier to manage with the stock fluctuations. So as the stock moves up and down, I can buy back calls, roll them, or buy back puts as well and roll them. So I could probably do better than about this 0.35 or 0.45 return per month. If I roll out to January 2016, I could probably do better premium-wise, not up front, not rolling for a credit. I'd still be rolling for a debit. If I took assignment now and sold, let's say, the February 72 strike or the March 72.5 strike, I'm getting a smaller premium. But if I do that month by month by month by month, after 12 months, we'd have a higher yield. And if the stock moves against me one direction or the other, it's easier for me to buy back the March call and roll to the April than look at trying to manage this January call where none of the time decay has worked in my favor yet. So that's one of the problems I have with the gurus who sort of charge money to tell you that, hey, if it goes against you, just roll down in strike and out in time 12 months, 15 months for a credit, and you'll be fine. It's hard to swallow for me. That being said, I can hear Ernie groaning in the office around the corner because he does that with some of his positions. When he gets put a naked put position, he'll be very comfortable rolling out 8 months or 7 months out in time to roll for a credit. It's not something I do. It can work out, and we're showing that here. But what about getting back to break even with a potentially shorter term repair? Okay, and this is something to consider in these situations. You get assigned a put because it gapped against you. To be honest with you, I probably would have, if this was a position I was in Deckers, as soon as that gap occurred, I would have been assigned the stock early, so I would have had to make this decision back on the earnings date because it's unlikely that I'd still be in this position without being assigned yet due to that decline. Okay, well, let's take a look. We know our cost basis is at $77.35. We see a couple repairs we could probably do out to the 10-month out, 12-month out period. We could look at September series as well on the fly to see what's available. Okay, but another opportunity. I'm going to put in DECK here on Power Options, and I'm going to go into the Stock Repair tool. Now I got to put in my cost per share, $77.35, and let's just put in 100 shares for our example. Let's go ahead and submit that. All right, now, not as close in as I had hoped. I'd hoped to see some April repairs. March was skeptical, but we can see some June repairs here, and then there's January repairs as well. Now what this tool did is it attempted to build a ratio call spread for us to help us get back to break even. You see here the strikes that are listed. So for the April 2015 expiration, it tried to build a repair for us using the 70 strike and the 72.5 call strike, which would have resulted in a net credit of $1.80. However, that does not get us back to break even, so we don't see any trade details. Now remember, what's important here is our cost basis, if we were assigned the stock, was $77.35. And we saw that we could sell some January 350-day out calls that would get us repaired. There might have been a September series we could have used, but here we have June series, only 4 months or so away. And we see here that we could build a repair, and our cost basis is $77.35, but note here, our break even now is $71.83 with this calculated repair. Now, stock's trading at roughly $71.50. So this position doesn't require the large movement back up. We don't have to worry about receiving a large upfront premium by going 10 to 12 to 15 months out in time as well. So even with this cost base of $77.35, we could look at a repair detail for this position. Now we're going to look at this first, and then we're going to talk about a different way. Here's what the stock repair tool does. It builds a ratio call spread, so I could buy one June 70 call option for $7.70. And we could sell two June 72.50 strikes for $5.70. So I'd pay out $770 here. We'd collect $1,140 for two contracts of the $5.70, and this would give us a net credit of $3.70. So already we've lowered our break-even down to about $74, $73 or so, and 70 cents from the 370 minus our 77.35. But how is this break-even at 71.83? Well, with that June expiration, yes, it's still 5 months out or so in time, 4 months, 5 months out in time. But at that point, if the stock's trading at 71.83, these 72.5 calls would expire worthless. We collected 370 against our cost basis, and our June 70 call that we bought would have a value of $1.83. So that 370 plus the $1.83 fixes the $5.52 that we would have had, and we're at break even now with the stock just at 71.83. We didn't have to go 10 to 12 months out in time. It's difficult to see this sometimes mathematically, but that's what the stock repair tool is building. Let's scroll back up, and there's our repair details. Let's look at Analyze Trade now. Click the Analyze Trade button. This will take us back to our profit and loss chart with our numbers. So a cost basis on Deckers of 77.35. We could buy again the June 70 call at 770 and sell 2 at 570. And here's our position. Now, it doesn't give us as high a return as that January position. We've taken an 8% loss to a potential 1.8% gain 4 months out in time because of this accelerated gain. What we've essentially done is we had a stock position, and we're selling a June 72.5 call against it. So we've got a covered call, and then we're selling that same June 72.5 call again, but protecting it with a June 70 call. So we now have got a covered call with a bull call debit spread. And if the stock is above 72.50, we get a sign on our stock. The bull put credit spread would give us that 250 back. So with only a small gain in the stock now, from where we are now over a 4-month period, we take that 8% loss into a 1.8% gain, and we didn't have to go 12 months, 10 months out in time by converting to a covered call or rolling down our put to the new strike. I know many of you, I talked to an investor the other day he never takes assignment, and that's perfectly fine. His preference is to always roll down the put and just keep managing the put. Well, this is an alternative for those of you that aren't set in that fashion. If I did roll down the put and he wanted to roll for a credit, as we saw, he'd have to go out to maybe January or December when it's available, perhaps, to roll for a credit. In this scenario, we can convert this position. Now, that all being said, if you're in an IRA account, you might not be able to do this in a sheltered account. If you're approved to do credit and debit spreads and covered calls, which you'd be approved of if you're able to do credit and debit spreads, you can do this adjustment. Your broker won't look at it as a ratio call spread, where you're selling 2 calls and buying 1. You could enter it as a bull call debit spread and a covered call, and if you're qualified to do that, this will help you get back to break even faster. Okay? Now, let's do something else. Let me go back again to our stock repair. Okay, so we said if we took assignment right now on our 79 strike put on Deckers, we keep the 165 premium. We have a cost basis of 77.35. Well, the stock right now is trading at 71.50. So what happens if I take assignment on my 100 shares? And of course, this is, so we're going to talk about the pros and cons of this, but now I take assignment and I buy another 100 shares at 71.50. This would allow me to average my cost basis down to 74.45 roughly. Okay, you can work the math on that with me, but then my new cost basis would be 74.45 if I average down to now 200 shares. Change my share price as well, and let's go ahead and submit that. Now, of course, with a stock at 71.50, we only have a loss now of about $3. Let's call it $3 even on the position. We could look to sell the 72.5 call for February expiration or March expiration, see if that would give us enough premium to get back to break even from our cost basis, and it probably would. But notice here, there are now repairs available for February and for March, where our break even is only at 72.68, lower break even. There's one here that was the same break even price, $71.68 for March expiration, now using the 72.5 strike. Okay, so let's take that break even. We get a $1.10 net credit. We've got a lower break even of 71.68. Let's take a look at the repair details. Now this is going to double. Since we have 200 shares, we can now buy 2 calls of the March 70 expiration for $4.30, sell 4 calls, twice as many as shares that we own, because 2 of those shares are going to be covered by our stock, 2 of the short calls are going to be covered by the long calls we're buying. So we get a net credit of $1.10. Now if the stock's at $71.68, we keep the $1.10 credit. Our 70 strike call is worth $1.68, but we only had to make back $2.77 this time because we averaged down with our price. Again, let's take a look at that profit and loss chart for our March series. Let's go to Analyze Trade. Okay, and so there's a break even. Now, it's a return of 2.2%, but remember, March is only about 37 days out in time. Okay, so it's about a 1% gain for the next 16 days, keeping in mind that we're converting this from what would be an 8 or 9% realized loss on the position. So the pros of averaging down, this management technique of averaging down and then using the stock repair, is that it gets you back to break even faster. We're turning an 8% loss into a potential 2% gain on the position, again, if the stock's above 72.50. We need less of a gain in the stock price to get back to break even. We're not in a position where we're tying up our capital for 10 to 12 to 15 months if we tried to roll for a credit as well. Now, what are the cons of this? Well, as Becky mentioned so astutely, and it's what everyone would look at, we originally entered this position, the naked put, with our cash secured value because that was the ideal position size we wanted to force. We didn't want to invest more than X amount of our portfolio in one naked put position, so we just did the 1 contract or the 2 initial contracts, maybe the 5 contracts, whatever your requirement is. Averaging down now, we're putting more of that capital. We're changing our position size as well, so we're putting potentially more good capital and a bad trade. That is a possibility. Okay, so that's one of the cons there, is it's more money in naturally. The other con of the stock repair, just like rolling to a covered call or just like rolling down to a lower naked put strike price to help repair it, is we've done nothing to address the downside. If Deckers continues to fall and fall and we cross this, thankfully, this March series, going back to Butch's comment, we wouldn't cross the earnings here by doing this repair to March. If we went out to the April, we would again, and that would be a concern. But here, we're not crossing earnings, but we still haven't done anything to address the downside. If the stock continues to fall in price against us, then we're going to have to do another management. The management technique, the stock repair, whether you do the stock repair with the cost basis or you average down to get a lower cost basis to see better stock repair opportunities, always remember that that only works if the sentiment stays. And in this sentiment, if I roll down here, yes, I have a new lower break even now of only 71.68 instead of 77.35, but in this scenario, I'd have to have the sentiment that the stock's going to stay the same or move back up in price. This was an overreaction. I feel confident the stock's going to stay around this price range. This repair will work for me. But again, the cons are in putting more money after bad. We haven't addressed the downside in the case of the stock still falling against us. Going back to what Martin mentioned, explaining the collar, could I buy a put now and convert this repair into a protected position where I have a limited downside gain? Yes, but it would likely negate all the potential profit. This 330 or 2.2% profit, remember now I'd have to buy 2 put options to cover the 200 shares of stock as well. So this 330 maximum profit would be drastically reduced. My new potential profit with buying a put to convert this sort of a collar repair would only be about 1% for the next 3 months, or 37 days, my apologies, but I would reduce the risk probably to only 4 or 5% or so. And why don't we take a look while we're here? Let's go in. We'd have to go into March. Okay, so March 20th, it's, oh, this is the 13th, isn't it? No, these are the 20th. I apologize. These are 44 days out in time. Okay, so let's go to the options there. 110 premium, so I'm going to try to keep it at the 62.50 put, 50 to 80. Let's just call it a 70-cent ask price. Remember, we did receive $1.10 or so premium here for this credit. So we're going to add that put. We're going to have to buy 2 of the 62.5 puts. We're going to put in a midpoint of about 70. Really be 65, let's use 70. Okay, so we negated the gain now from 330 to 190, and unfortunately I don't like this because that risk is still too high. Okay, so let's go back up. If I'm doing a collar for protection, I want to keep it around a range of a max risk of only 5 or 6%. That's when I open a collar to begin with. Let's go to a different strike. Let's try the 65. We'll call it $1. We got to buy 2 at $1. 12.6% risk, and we take it at only a 0.9% gain. Okay, so the stock repair, this is a good illustration, so I want to impress upon you that the stock repair, just like taking assignment and rolling to the covered call, just like buying the close your put and rolling out maybe 10 months to repair this large decline, still has to match the sentiment. Okay, this still has to match the sentiment that I feel the stock would move up, protected it a little bit here, but is the 0.9% still something? It's better than taking an 8% loss, don't get me wrong, but am I better off maybe doing a different adjustment in this case if I'm only making a 0.9% gain? Technically, we do have to consider this is almost a 9% gain because we have the 8% loss right now. But that's the key, turning the losers into a winner. I just wanted to illustrate to you, those of you who haven't seen it before, the stock repair tool, whether on the current cost basis or averaging down, but remember the risks of averaging down. You're taking more of your portfolio to do it. You're still not addressing the downside risk in case the stock continues to drop in price against you. Okay, let's go back to our slides now. And that's basically the management techniques we want to discuss for our 3 scenarios today, and showing some of that availability and power options. The preemptive moves, okay? How do we avoid this in the first place? Well, you always want to have a plan in place. When we open a naked put position, last week we talked about what criteria we would look for, how to avoid some of the catches that Butch mentioned. If we want to avoid the earnings, we want to do our due diligence, make sure there's no headlines that are available that show us anything about a pending patent lawsuit or anything of that nature. We want to make sure that this position we're comfortable in, and again, we want to make sure that when we sell a naked put, we enter it on a stock that we would perhaps not mind owning for long term, because regardless of what management techniques that you use, regardless of the premium that's available, you are entering a contract with a naked put strategy where at any time you could potentially end up owning shares of that stock. That's your obligation when you sell your put option. So you always have to keep that in mind, and as a rule, you shouldn't sell a naked put unless it's on a stock that you wouldn't mind owning long term. But the preemptive management techniques. Number 1, let's not let the stock drop below the put strike price if possible. The unexpected event, even regardless of earnings, we had a customer I talked to 2 weeks ago. Unfortunately, he was in a position where earnings were not coming out till 2 weeks after his expiration. But unfortunately, knock on wood, the company came out with an early earnings warning announcement 4 weeks before the earnings event. The stock plummeted 20%. What can you do? Couldn't see it coming. No stop order would help you in that. Okay, you set a stop order at an 8% stop loss from your break even on a naked put. The stock drops 25%. Well, you're still getting put the stock at that strike price. The stop order didn't help you in that scenario. Okay, as a general rule of thumb, we typically like to do is try to set a stop that's around 1% of the short put strike price. So if I sold 100 strike put, I may look to manage the position or start evaluating adjustments if the stock drops down to 101 or maybe somewhere along those lines. So the stock's not trading at 101, I'm holding the 100 strike put. I may consider adjustment if the stock is within 1% of my put strike price. Because as we talked before last week, when I opened the position, I was probably 5 to 7 to 8% out of the money or more to begin with in that scenario. And at the same time, we probably had a higher probability, and we had a higher percent to break even of maybe around 11%. So if the stock has now moved down against me, I opened it when the stock was at 110, it's now trading at 101 or 101.50, I might look to start managing the position. When you open a naked put, you probably look for stocks that were trading above a 50-day moving average or in an uptrend. Maybe use EMAs, for example, or maybe use MACD as part of your stock research and analysis, Bollinger Bands, stochastics, things of that nature. Well, if I was using that criteria when I opened the naked put, I probably want to consider adjusting my put position if that reverses. So if I originally ran a screen and looked for stocks that were trading above their 50-day moving average for my naked put candidates, and as I'm in the trade, the stock now drops below the SMA 50, I might consider rolling out of the position or getting out of the position. If the MACD crossover happens, I originally looked for positions where the MACD was above the signal line, but now they've crossed back. We've hit another crossover. I may consider adjusting the position. And again, other things, if you use stochastics or Bollinger Bands, other technical indicators, if the trend reverses from when you entered the position, then you use that as part of your criteria, that might be a trigger to look for adjusting. If you use the probability or the delta, okay, so if you originally open naked puts and part of your criteria is you only sell naked puts if the delta is 0.3 or less or negative 0.3 or more, negative 0.3, negative 0.2, negative 0.1, but then when you enter the position, the delta now increases to 0.5 or 0.6, that might be a management technique. Or if I started a position that had a 75% probability, but now the probability on that put as we get closer to expiration has dropped down to maybe 60% or 55%, I may consider management. And another way you can set sort of alerts or contingent orders to stop your position, mental stops or hard stops as well, is premium. Now, we talked about that original position on LUV where we received 55 cents. Well, I may look to buy to close that put if the loss now is 25% or 50% above. So if it cost me 75 cents to buy it back, or we saw it cost us $1 to where we're taking a 55-cent loss or 45-cent loss when we originally expected a 55-cent profit, you can use that as a gauge. But the problem is you can't be too restrictive. Another customer I talked to yesterday wanted to look at bull put credit spreads and also naked puts and covered calls with the concept of, okay, well, I opened the position originally, this put for 60 cents. I want to close it if it costs me 50% of that to buy it back. So if the ask price or the close price reaches 90 cents, so I'd lose half of what I expected to make, right? We got to pay 30 cents of the 60 cents we expected to make. He was going to look to close it. The problem is at the onset of the position, the put he was looking at, the bid was 55 cents, the ask was $1.10. So he got a 60-cent premium to open it, but using the midpoint, the ask is already at his 90-cent stop. So if you set a stop based on the net premium you received, and based on the value of the option is going to fluctuate wildly in price. And if it has a wide bid-ask spread, you're going to find yourself getting closed out of positions very frequently for losses. You're not allowing that to really mature, so you've got to be careful about trying to set stops on option net credit or option premium that's too restrictive, because you'll just get closed out of positions 2 or 3 days after you've opened every position for losses. You're not going to really get ahead that way. You are mitigating your losses, but you're not getting any gains in that scenario. So you've got to be really careful with that when you start using the option premium, or in the case of a credit spread, of course, the net credit. Now, why do I mention credit spread when we're talking about naked puts? When we talk about these ideas of rolling or adjusting our naked put trade that goes against us, as Butch mentioned, as I always do, anytime you're looking to roll out to a new strike, don't just roll for the sake of rolling. My stock X dropped against me. I was taught to roll down the put to roll for a credit or try to roll for a credit. Let me just do that. No. Reevaluate the stock. Almost go through the same process and due diligence you did researching the stock when you opened the position to make the adjustment. Okay? Now, let's be honest, you're in the trade. You opened it originally, you did all your due diligence 14, 16, 20 days ago when you opened the position. So you know the stock. You've been in it for 20 days. You see how it's moved. You know the event that likely caused it to drop against you as well. So you have a better gauge now of what's going on with the stock, what's going on with the market. That is very true. But I still want to take a look at what is the contingents. What are the criteria I would normally use to open a new naked put position, and apply that when I'm looking to roll. Don't just roll down because a rollout opportunity is available. Reevaluate and say, look, I'm rolling down from my 79 strike on Deckers to the 12-month out 71 strike for credit. However, do I feel confident that the stock's going to stay above 71 for the next 12 months or at any time? You know, or just rolling down in general. If you've got that small loss we saw with the Southwest position on LUV, rolling down from the 45 strike to, let's say, the 43 strike for 16 days out, well, do I feel confident the stock's going to stay above 43 in the next 16 days? Otherwise, we always use the cliches, but if you keep rolling down in that fashion, the stock keeps moving against you, you're just trying to catch a falling knife. You're always going to lose more on the buyback cost of the put that you have that's going in the money than you're able to get back from the option premium that you're selling. And that's just the nature. Same with a covered call position. You're always going to lose more on the call if the stock gaps up, moves up 5 or 6 points when you're in that covered call. It's always going to lose more on the option that you sold than you're going to be able to get back by selling a new premium. And the other concept, of course, is that when I roll now, I've got a naked put, it's moved slightly against me, I'm going to roll down in price, but I'm still a little bit concerned. Rather than converting it to a collar, if I took assignment, you could convert it just to a bull put spread if the profit matches. In other words, you'd still buy that same put. So if I rolled down my love position from the 45 put down to, let's say, the 43 put, and I managed to roll for credit in this case, because remember, we were just slightly out of the money, or slightly in the money with our 45 put on LUV. We roll down to the 43 strike, and we receive a decent credit. I may consider buying a 40 put with the same expiration of my new 43 put to create that risk-reward profile of a bull put credit where I have a limited loss to the downside and I still converted it to a potential profit. But again, as you pay money out to buy that new put to convert to a bull put, you're giving up some of the premiums, so you're not going to see a larger return as well. But again, I might sound like a broken record, but I always want to emphasize that. I see too many investors doing that. Just, oh, stocks moved against me, let me roll my naked put down a strike for the next expiration. Let me roll my covered call down. Let me roll my bull put credit spread down. If you no longer have a neutral to bullish sentiment of the stock, then why are you doing a neutral to bullish position? Okay, that's another thing to consider. Is always make sure the sentiment matches before you roll. Make sure you do your due diligence before you roll. Make sure you're avoiding earnings, anything that might cause you hesitation in the headlines. And we talked about those as well, and try to make back your profit. Okay, I'm just going to flash this up here for those of you that currently trial members to Power Options. The tools we showed today and the tools we showed last Wednesday for the search and analysis are those powerful portfolio tools to help you track and evaluate rollout opportunities. We are doing all the heavy lifting and math for you. Our 20-minute delayed service is only $60 per month. And of course, we do support over 23 of the commonly used option strategies. We do offer a back testing service for the various strategies. You can look at historical chains, for example. So the 20-minute delay plus access to the historical tools is only $40 more, so it's a total of $100 per month. And of course, we also offer a real-time service. So every time you submit the search, refresh your portfolio, refresh rollout opportunities, you're getting the numbers and the calculations at that very instant, and that's $100 per month as well. Well, I want to encourage you, if you guys have any last-minute questions, we are at 1:20, go ahead and send those in as well. But at any time you have any questions, please feel free to send us an email to support@powerop.com. Of course, you can also call us during market hours. If you live inside the U.S., you can reach us toll-free at 877-992-7971. And if you live outside the U.S., you can reach us at 302-992-7971. Of course, there's contact links on the bottom of every Power Options page. All right. Well, Theo, thank you for joining me as well. I'm glad you enjoyed the presentation. And Becky, thank you as well for your comments, and Butch also. I hope you all enjoyed the presentation. Let me switch gears very quickly, one more before we wrap up here. I'm going to go back to Power Options very quickly. Just remember, if you go to powerup.com, of course, you're on your trial or subscription account. Go into the free webinars tab. Under the options strategy section on the webinars page, so you've got the tools, archive webinars, options strategies, options concepts, and requested topics. Well, the introduction to naked puts from last week, you'll see that there from 1/28/2015. Today's presentation will be available in this section as well, probably around 4 or 5 p.m. Eastern Time this afternoon. Now, for those of you that currently aren't trial members or subscribers of Power Options, well, I encourage you just to go to powerup.com. You can sign up for a 14-day free trial. We just require first name, last name, and email address as well. So that'll get you a 14-day free trial. But at any time, this is also a public page. The archive webinars page is a public page. I'm sending you all a text link to that. It's poweropt.com/webinars.asp. So you don't need to be logged in to view these at any time. So you can evaluate that. You can take a look at the webinars at any time just by going to powerup.com/webinars.asp. You'll see various presentations on the tools, the option strategies, some of the options concepts that we discussed, implied volatility, a presentation on the Greeks, insuring your stock individually or portfolio, and then our requested topics, typically our Friday Q&A sessions, our open discussion, open forum Q&A sessions from Friday, and there's other smaller webinars, shorter webinars that are going to be posted here as well for different segments also. All right, well, ladies and gentlemen, thank you again for joining me this afternoon. I hope to see you at one of our next presentations. We will be back on Friday for our open discussion presentation, of course. And then next week, we'll probably have another strategy discussion as well, maybe related to just covered calls or maybe related to spreads again as well. We'll take a look at that for next Wednesday. Thank you again, ladies and gentlemen. Take care. We'll see you soon. Good night.